Today, schizophrenic markets wrestle with countervailing trends. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. This is the first of our market reviews, and we're now back in normal operations. And by the way, next Tuesday at 8 p.m. Sydney time, we'll be doing our first live stream, and that'll be with Damien Klassen, so watch out for that. Anyway, once again, we saw contention in the markets as US equities extended a rally on Friday as investors weighed strong corporate earnings against concerns about regional banks and inflation. Treasuries rose, but investors may be cautious ahead of Apple's results due next week, and of course the FOMC's meeting and the US jobs report for April. And later in the day, First Republic once again stole the show. Overall, the S&P 500 gained 0.8% after better than expected earnings from the likes of Exxon Mobil and Intel, which are up 1.3% and 4% respectively. However, the gains proved precarious in midday trading after Federal Reserve officials called for broad changes to bank rules in the wake of Silicon Valley Bank's collapse and promised tougher supervision and stricter rules for banks. The Nasdaq rose 0.7%, weighed down by Amazon, dropping 4% after a warning over growth in its key cloud computing business. Meanwhile, after the market closed, First Republic Bank tumbled 49% to $1.77 after reports the regional lender was headed for receivership. That was after the bank's 43% decline in the regular trading session. In fact, the US Federal Deposit Insurance Corporation has asked banks, including JP Morgan Chase and PNC Financial Services, to submit final bids for First Republic Bank by Sunday, after gauging their initial interest earlier in the week, according to Bloomberg. The bank regulator reached out to banks late on Thursday, seeking indications of interest, including a proposed price and estimated costs to the agency's deposit insurance fund, the report said. Based on those submissions on Friday, FDIC invited at least two firms to the next step in the bidding, the report added. The news comes as FDIC is preparing to place First Republic under receivership imminently after the regulator decided the troubled regional lender's position has deteriorated and there was no more time to pursue a rescue through the private sector. If the San Francisco-based lender falls into receivership, it would be the third US bank to collapse since March after the collapse of Silicon Valley Bank and Signature Bank. So, while earnings might be relatively firm, the issue remains sentiment and positioning. Analysts now expect first quarter earnings for S&P 500 companies to fall about 1.9% from a year ago, compared with a fall of 5.1% which was expected at the start of April. But markets are on the edge over the uncertainty of Federal Reserve interest rate hikes after fresh inflation data on Friday increased the likelihood of an increase next week, and possibly in June too. Traders have been anticipating the end of rate hikes near term, with cuts before the end of the year, but as I've said several times, this looks to me very unlikely now. For the month, the S&P rose 1.5%, while the Dow added 2.5% and the Nasdaq was barely higher, as corporate results lifted investor sentiment in the face of rate hike uncertainty and a possible recession, which is still there in the background and still looming large in my view. April largely was a good month. Again, it's probably earnings season driven, but we've been getting some economic reports that are just also saying that the economy, and especially inflation, is likely going in the right direction, but just not maybe fast enough, said Kim Forrest, Chief Investment Officer at Boca Capital Partners. Businesses and people are spending. Inflation is still there, but the data says it's slowly ramping down, slowly being the operative word. The Personal Consumption and Expenditures Price Index, excluding food and energy, which is one of the Fed's preferred gauges, rose 0.3% in March for a second month. Compared with a year ago, the measure was up 4.6% according to Commerce Department data. And data showed US consumer spending unchanged in March, while underlying inflation pressures remained strong, feeding expectations of that 25 basis point hike next week. Other data showed first quarter US economic growth slowed more than expected, while plunging consumer confidence in April heightened fears of a recession. What looks like sticky contemporaneous inflation remains an issue, preventing the market from getting too carried away on the rate-cutting phase to come in subsequent quarters, wrote Patrick Garvey, head of global debt and rates strategist at ING. The yield on the 10-year Treasury fell 9 basis points to 3.433%, but Seema Shah, chief global strategist at Principal Asset Management, sees stagflation as by far the worst-case scenario for risk assets and said there is a meaningful chance of further rate hikes from the Federal Reserve beyond May. Now, the Volatility Index, otherwise known as Wall Street's fear gauge, closed down 1.25 points at 1578. That's its lowest close since November 21. But, as I reported last week, this index is becoming increasingly meaningless due to short-term option trading. Elsewhere, oil prices gained, gold was little changed, and the dollar was modestly stronger against major peers. Oil prices edged higher on Friday, helped by the risk-on sentiment caused by generally upbeat corporate earnings, but posted a second weekly drop as the disappointing US data on growth added to fears of a global slowdown. US crude futures traded up to $76.69 a barrel, while the Brent contract also climbed. Both benchmarks, though, remain well down from recent highs on recession fears, taking their drops close to 10% over the last 2 or 3 weeks. The Stoxx 600 gained 0.6%, even as an uptick in consumer price gains pointed to more rate increases by the European Central Bank. The DAX in Germany traded 0.77% higher, while the FTSE in London was up 0.5% and the CAC 40 in France was up just 0.1%. The corporate earnings season continued in Europe on Friday, with Mercedes-Benz falling 0.3% after the German vehicle manufacturer posted a fall in year-on-year earnings, even as it raised the outlook for its vans division, seeing higher demand in the US and in China. NatWest Group stock fell over 3% after the British bank's first quarter operating profit beat expectations, but this was largely by setting aside less than expected for bad loans, thus underperforming a number of its peers. In other news, Numis stock soared nearly 70% after Deutsche Bank agreed to buy the broker in a deal valuing it at £410 million. That's a premium of 72% on the company's closing price on Thursday. Away from the corporate sector, investors are carefully studying a flood of growth and inflation data ahead of next week's European Central Bank's policy setting meeting. The ECB is widely expected to raise interest rates in early May, but the size of the increase is still up for debate, as are future monetary policy decisions. The state of North Rhine-Westphalia, Germany's most populous, released its April consumer price index earlier on Friday, coming in at an annual 6.8%, still, of course, at an elevated level. And initially, French CPI grew 5.9% on the year in April, ahead of the expected 5.7%, while Spanish inflation came in at an annual 4.1%. That's above the prior month's 3.3%. And the Eurozone GDP number is still looking pretty sick. However, both the French and Spanish GDP numbers, which were released on Friday, offered hope for an upside surprise as they came in stronger than expected. Additionally, EU finance ministers and central bank governors met in Stockholm. But interestingly, the European Central Bank is preparing to approach index providers for its debt to be included in their government bond indices, as EU officials told Reuters, a move that would attract steady demand from a much bigger pool of global investors. Index inclusion is something we are discussing with market participants at the moment, while we are also doing our internal analysis, the official said, looking at how the EU fulfills index providers' criteria. EU bonds are included in broad bond indices, but inclusion in dedicated government bond indices compiled by the likes of Bloomberg, JP Morgan, or the FTSE Russell would be a game changer as trillions of dollars of investor funds track those indices, and they would become effectively forced buyers. EU funding officials have said investors do not treat it like a government, even though it is raising hundreds of billions of euros in joint debts with the backing of member states. It's our objective to be included in European government bond indices because this will support how EU bonds are trading in the market. It would finally support the political objective of a common joint financing at a European level, the official said. The EU is a supranational institution, not a national government, and public documents outlining criteria for inclusion in government bond indices do not cite exceptions to include other entities, but focus on the size, currencies, and credit ratings of government bonds. The EU has set out to raise around 800 billion euros in common debt by 2026 to finance a post-COVID recovery fund, in addition to an earlier pandemic scheme, becoming one of the world's biggest bond issuers in less than 3 years. Having focused so far on setting up its fund infrastructures, the EU is now boosting its efforts to be treated as a government borrower. But whilst it's AAA rated, it has shorter-term borrowing costs which are higher than those of lower-rated Spain and Portugal. That's because the EU is still not treated like a government the way Germany or France is, and its bonds have less liquidity compared to governments, traders said, undermining aspirations for the debt to become a Eurozone safe asset. If funds have to hold EU bonds because they are part of their benchmark and they're tracking those benchmarks, it's basic economics, there's going to be more buyers and sellers, said Royal London Asset Management Fund Manager Gareth Hill, adding this would reduce EU borrowing costs. The EU has also started selling the bonds backing its various schemes under a single label and is preparing a framework for banks to provide investors with regular pricing quotes. A repurchase agreement facility launched in 2024 will also make it easier for investors to take positions. And big investors are also calling for index providers to treat the EU as a government. We have pushed for that in the Index Inclusion Council from Bloomberg, one of the largest index providers, although we think it will be difficult, said Casper Hentz, Senior Portfolio Manager at Blue Bay Asset Management. Hentz said a sticking point from an index provider perspective was that the EU does not have access to direct tax receipts. The EU official noted the bloc has elements of a sovereign such as a budget and at least indirect taxing powers through member states' contributions. And Cosimo Maracia, head of fixed income absolute return at Europe's largest asset manager, Amundi, said it was also calling for EU inclusion in government bond indices. You have bonds which have shared risk between different countries, even if it's issued by an entity which does not have a tax power. But I don't think it's relevant. It's part of the integration that we have at a European level been seeing, he said. Most Asian stocks rose sharply from recent lows on Friday, tracking an overnight bounce in Wall Street following a series of strong earnings, while a dovish outlook from the Bank of Japan sparked a rally in the Nikkei. Still, most regional indices closed the week flat or lower amid persistent concerns over worsening economic growth and rising interest rates and recession fears. The Bank of Japan, in contrast, renewed its commitment to stimulus after its first meeting under the new governor. It left its short-term policy rate at minus 0.1% and maintained its 0.5% ceiling for 10-year bond yields. Japan's Nikkei 225 index jumped 1.4% after the Bank of Japan held interest rates at record lows and said it will patiently continue with its quantitative easing and yield curve control measures. The move points to accommodative conditions for Japanese stocks, which is likely to facilitate more buying into markets flush with liquidity. But the bank slightly hiked its inflation outlook for fiscal year 2023, and data on Friday also showed inflation in Tokyo, Japan's capital, rose more than expected in April. The reading heralds a similar trend in nationwide inflation and could signal growing pressures on the BOJ to eventually tighten policy this year, a possibility which the new governor has already raised. Broader Asian markets rose, recovering a measure of their losses this week as technology-heavy exchanges were supported by a series of stronger than expected earnings from major US tech firms. Hong Kong's Hang Seng added 0.27%, while the Taiwan-weighted rose 0.8%. India's stocks were the best performers in Asia this week, with the Nifty 50 trading at 2-month highs after a string of strong local earnings largely offset weak global cues. Financials played a key role in the Indian stock rally, following consensus beating results from Bajaj Finance Limited and ICICI Bank. And Reliance Industries, India's largest company by market capitalization, also logged a 19% jump in its quarterly profits. China's Shanghai Composite Index rose 1.14%, extending a recovery after a nearly 4-month lows were hit earlier in the week. But sentiment towards broader Asian markets remained largely cautious as softer than expected US GDP data soured sentiment towards risk-driven assets. Stronger than expected inflation and labour market readings also pushed up concerns over more interest rate hikes by the Federal Reserve ahead of its meeting next week. Weak economic readings from China also weighed on sentiment as Asia's largest economy logged a substantially bigger than expected decline in industrial profits for the first 3 months of the year. Now in Australia, Australian shares climbed from a 2-week low as Megaport brightened a mixed season for local technology shares after a rally on Wall Street. Shares in the cloud connectivity provider rocketed 41.5% higher to $5.63 after it said its earnings will be materially above market consensus because of steps it took to improve financial performance. Megaport expects normalized earnings before interest, tax, depreciation and amortization for the year ending June 30 to be in a range of $16 million to $18 million. That's about double market consensus of $9 million. The benchmark ASX 200 finished the session with a gain of 0.2% or 16.5 points at 7,309. Fellow tech BrainChip Holdings sank 3.6% to 41 cents after it reported net cash outflows accelerated to $6.3 million in the March quarter from $1.9 million in October to December. The company ended the March quarter with $17.7 million, down from $23.1 million in the prior period. The local technology sector posted a gain of 0.5%, while consumer staples were one of the worst performing sectors in the benchmark index as supermarket shares tumbled. Coles, for example, reported that its sales rose 6.5% to $6.97 billion in the 3 months to the 31st of March. But shares fell 1.4% to $18.20, while shares in its big competitor Woolworths fell 0.8% to $38.83, and Metcash traded the day down 1% to $3.90. Iron ore futures traded lower on the Singapore index, down 0.6% late on trading in the afternoon at 104.81. The major miners ended the day stronger, with BHP up 0.2% to 44.40. Rio Tinto edged up 0.1% to 112.25. And Fortescue Metal Group was out in front, gaining 0.4% to finish at around 20.94. The big four banks all ended the day in the green, with ANZ 1% higher at 24.35. Westpac firmed 0.9% to 22.47, Nabro 0.4% to 28.84, and CBA edged up 0.3% to 99.36. Macquarie was up 1.05% to 182.60. But PointsBet tumbled 6.1% to $1.55 after its quarterly update showed turnover momentum in the US was slower than expected and its cash burn was higher than expected, Goldman Sachs said. Medibank will not release the findings of an external report investigating a cyber attack. The company said Deloitte had made recommendations to enhance Medibank's IT processes and systems, but did not provide details of those recommendations. Its shares rose 0.3% to $3.56. And Mirvac reversed its earlier losses despite cutting its earnings guidance for the year ending June 30 because of weather delays on residential projects. Earnings per share could be at least 14.7 cents per share, down from its February guidance of at least 15.5 cents, the company said. Its stock rose 3.4% to $2.41. Now, interestingly, Westpac says it now expects the Reserve Bank of Australia to leave the cash rate on hold at next Tuesday's meeting and has subsequently lowered its peak rate forecast to 3.6% following the better-than-expected March inflation report. The inflation report is in line with the RBA board's path to achieving its stated objective of having inflation back at the top of the 2 to 3% target range by mid-2025, said Westpac chief economist Bill Evans. Others may disagree. And finally, in cryptoland, Bitcoin is holding below 30,000 US, but is still tracking the major markets. In fact, Bitcoin experienced sudden volatility on Wednesday, dropping almost 3,000 US in less than 3 hours, impacting both long and short-term positions held by traders. The overall impact of this sudden volatility spread to a broader segment of the Bitcoin market, liquidating as much as $175 million worth of future positions and wiping out up to $1 billion in open interest within 24 hours. Sudden spikes resulting from market volatility are the bane of long-term positions, of course. Under such circumstances, open trades whose margins get exhausted or highly depleted are closed automatically by exchanges and trading platforms. The recent volatility experienced in the Bitcoin market spiked both ways. The price dropped extensively and liquidated several long positions. The price bounced after activating sell limit orders, only to spike higher and then have them liquidated. Only trades with high margins and extended risk exposures survived the volatility. Reportedly, the crypto exchange OKX had over $52 million in Bitcoin liquidations on its platform, while Binance liquidated orders worth $38 million, and the most substantial single liquidation was on BitMEX, with the value there at around $6 million forcibly closed. The expectation of favorable monetary policies in the US pushed Bitcoin above 30,000 US, which is a bit of a psychological level, but it didn't last long. And as those sudden sales came through, it dropped to around 27,000 and then moved a little higher again. But of course, Bitcoin is subject to so many external and internal issues. Nobody knows where true value is. So this high volatility situation is likely to continue. And more broadly, I think markets will remain troubled because of these contentions between the expectations of higher interest rates potentially, inflation still raging, and on the other hand, some companies doing reasonably well. Of course, the main reason that many companies are doing quite well is because they're able to pass on significant price hikes. As I've said before, one of the factors in the inflation story is the way that the supply chain costs have increased dramatically from company to company. And of course, end consumers and end businesses ultimately end up paying the price. So there is some short-term issues here. And that is why I still believe that the Fed is likely to hike rates. And my own position with regard to the RBA next week is that they will probably also lift rates. Because while the inflation number overall was relatively benign in the scheme of things, below the waterline there were a number of rather worrying signals about the stickiness of inflation. And as Phil Lowe has said several times, inflation needs to be quashed. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.